we have a combination of fully remote employees because we don't have a corporate location. But where we have a corporate location, we have employees come in, and that is a requirement. Now, are we flexible? Sure. If they have a baseball game to go to with their son, or if they've got to take their parents, aging parents, to medical appointments, absolutely. You've got to be very flexible. But these are things that I think all employers are going to adjust to. And I think the mix of travel between corporate, transient, and group is also going to change. I don't I don't see that complete equilibrium being reached anytime soon. I think it's going to take a little bit. Some markets have already got there, but other markets are taking a while, and therefore hospitality in these other markets that relied on what I call corporate travel are not there yet.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Sundip Patel. Sundip is the CEO and co-founder of Avana Companies, an asset management and fintech firm that specializes in commercial real estate, private credit lending, and investing. And in just a minute, we're going to speak with Sundip about the impact of return to office trends on the hospitality industry. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Sundip Patel. Welcome to CRE Radio.
Darren, thank you for having me. I really appreciate it. It's lovely to meet you.
Well, likewise, and I'm really looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I'm a serial entrepreneur. I started the company 23 years ago. The vision and the mission was to provide capital for small businesses in America with one goal, which is to help them create jobs and retain jobs in America. And over the years, in the last 7 years, we then added renewable energy. So the goal was to also help promote clean energy in America. So we've kind of focused all our investments in these two arenas. Today, predominantly, we're doing a lot of real estate development in markets, and that's at the forefront more today than the renewable energy segment for Avana.
Got it. So you started out, it's just more like a business lender for like equipment, or was it far and wide, or was it real estate focused?
When I first started, it was to just help small businesses get ready to raise capital through their banks. So I was their outsourced CFO that then morphed into being a broker for them to find them the capital. And then that morphed even further when a Levinson family out of New Mexico that ran a bank noticed how I was doing business. And then they invested in us to help them grow their portfolio for their own bank. But also, we learned a lot along the way through Bob Levinson Sr. He's passed away since then, but he was a great mentor to tell us about exactly how to build a lending business. And so that was the start, basically. Yes, we focused on helping small businesses grab capital from banks, credit unions, morphed into just finding capital for any type of assets, equipment, real estate. And then eventually we settled on just doing real estate development, real estate construction, and financing because of the Levinson family.
Got it. And your focus continues then real estate focused, but you do both new construction and acquisitions. Is that right?
Yes, yes, we
Okay.
do new construction, acquisition, partner buyouts, opportunistic buyouts. I mean, so yes, it's a myriad of circumstances that present themselves to a entrepreneur, and but it's all real estate focused today.
Got it. And as such, are you, you mentioned earlier that you were kind of a broker and then you said it was Levinson? Is that the
Yes,
fam?
yeah,
Okay.
Bob Levinson out of New Mexico.
Okay.
They own a bank.
Got it. So have you had to raise capital to lend, or have you had kind of a steady supply through the Levinson relationship?
No, after the Levinson family then morphed into regulators coming in saying you either buy out the Patels or they become employees. And around that same time, his son wanted to come in and run the bank as well. So Bob was kind enough to seed us, and we started our first fund from there. And that was around 2009, 2010. And basically we grew from there. Then after that, I raised capital from family offices, institutions, pension funds, sovereign wealth funds, and that's a much more difficult existence because early on, having a mentor and a partner like a bank that works with you was a somewhat easier, not completely easy because you still have to make sure that you're abiding by the regulations. But the point is you're not doing two things, right? You've got the capital equation figured out. All you're doing is the origination side. Here we have to do both, and we still do today. To this day, 90% of my time is meeting with investors, raising capital, and assessing risk in what kind of investment opportunities we should be guiding the firm. And then the other side of the business, which is origination, is taken care of by my partner.
Got it. Yeah, no, it does become a a multiple of difficulty if you have to do both as opposed to,
Yeah,
being able to
one,
focus on just the one aspect.
one.
That's
Yeah,
great.
yeah.
So, all right. So, Avana Companies is primarily focusing on lending to real estate opportunities. You mentioned before we started recording that you're in Philadelphia right now. Is that right?
Yes.
Okay.
Yes. Yeah. One of the things that we've pride ourselves on is that we meet with every business borrower that we are lending money to. Darren, it's so important to look at the eyes, the whites of the eyes of people that you're giving money to. You want to understand their life, what's going on with them, right? Character is the hardest thing to underwrite. I've been doing this for 30 years. I can tell you we've got market data on every type of asset you can possibly look at in America, and we get out on the ground, we survey the streets, we watch the parking lot, we'll stay sometimes overnight to just see the activity in the business. But the hardest thing to underwrite is the character. So I travel, as do my C-suite employees, to meet with borrowers. We want to look at what is going on in their lives. So at least when things go wrong, they reach out to us. And this also works because they're the first source of referral. So I'm in Philly looking at an asset that we invested in, and that's part of our sort of mandate. We travel. So when we're sitting across the investor, and they say, "Well, when was the last time you went here, or when did you visit this?" One of us can say, "What was that? Last year or 6 months ago, or whatever," which is
Thursday at
important.
2 o'clock. Yeah. No, that's That is, I mean, that's as an insurance broker myself, I know that's depending on the size of the opportunity, it's almost a forgotten thing on a lot of the smaller business. I used to spend majority of my time out, knocking on doors or face to face with people, and it seems like a lot of the technology's kind of
Yeah.
gotten in the way.
Yeah, it's gone
But
away. Yeah.
but but that whole there is no substitution for, as one of my real estate clients says, it's a belly to belly business, and like you said, when you know somebody, there's a much better opportunity to read the character, like you said, and
Correct.
and um, and that what you find, or what I've found over time, is it's not always what it appears to be. Uh, and a lot of times you can find out uh, the unfortunate in that if you don't really feel good about or know the person, or didn't really get a chance to underwrite their character. So that's I love hearing that. So
Yeah. Yeah.
so let's talk a little bit about this topic of return to office trends,
Sure.
specifically on the hospitality industry. And my first question, do you lend a fair amount to hospitality type businesses?
Yes, that's one of our largest segments, actually. We've done close to, I think, 2 billion to just minority entrepreneurs in America that are in the hospitality space. So yes, it's a very big market for us. But you started asking the question about the return to office. Return to office in certain markets, Darren, is coming back. Yes, it's when large companies are mandating that people come into the office. And typically that's still on a hybrid basis. I'm seeing more like 3 days, 2 days remote, right? And that had a dramatic impact on hospitality. If you had a hotel in downtown Los Angeles, you relied on offices being fully occupied. Therefore, corporate travelers would come in and you would need a place to stay. Vacancies have gone up, and I wouldn't say that they've caught up to pre 2019 levels yet, but it's coming. But it's in specific markets. It's not what I call a trend that's occurring across all, let's say, the top 200 MSAs, metropolitan areas in America.
Yeah. No, I'm seeing that, and it's a sad reality just how we had COVID, and then we
Yeah,
had the Black Lives Matter, and then the just the technology. I mean, what we're doing right here, the Zoom, and
yeah,
and
yeah.
all of this. The technology is an interesting piece in that it was available, but it was not
Right.
widely
Used.
used.
Right.
Um,
Right.
but now that we've widely used it, there's a level of comfort that has, I don't know, it's kind of more ubiquitous. I mean, people are, if you say you're going to Zoom somebody, it's not like you don't get a strange look, like a what? Um,
Yeah. Yeah.
but
Yeah.
and I think there's, the ebb and flow of technology and how it works in our lives, and kind of that, tack through the middle, all this way, all that way, kind of thing. I think my hope is that there will be some sort of a comfort hybrid that does facilitate all the needs. But I am curious, and to get your expertise and more kind of an informed opinion about how this hybrid works as opposed to the traditional model. When pre-COVID, businesses were, Monday through Friday, 8 to 5, business travel, to and fro, and, nights out on the road, kind of thing. And then we went to, like nobody could travel, and nobody was spending any money. And I mean, I think a lot of the hospitality businesses they took it on the chin pretty good, that and offices.
Mm-hmm.
So can you kind of walk us through what it looked like pre-COVID, what it
Right.
what it was during COVID, and how you see it uh, morphing into the future?
So I'll start by explaining, um, and this is personal in the sense that this is something that's occurred in our family. When my nephew was asking, why not stay remote? Why do I have to go into the office? Now, there's a generational difference because I didn't have that option when I was looking for a job. I had to go in. There wasn't where I could do it from remotely. Plus, the technology wasn't there. Now, the new generation, obviously, when they ask the question like that, I always give them my opinion. My opinion is this: if you want to be at the center of influence, where the CEO or the chief operating officer, the CFO is sitting, you want to learn from them, you want to, through just osmosis, interact with them, you need to be in that physical surrounding. That's number one. Number two, how else does someone teach you that that you can formally present a particular way and get immediate feedback in a room? And that you don't get that opportunity on Zoom. You get it when you're in front of people. You live off their energy. You live off you kind of learn how to assess body language. So that's the kind of advice I gave to my nephew. The third part was, when you are in an office environment, you learn how to shake hands, you learn how to greet people, you learn how to conduct yourself. You have to get up, you have to get dressed, you have to be disciplined. And so these are things that, now, some people do not attach as much importance to this, but I simply think that it is important if you're going to build a career and eventually, hopefully, lead or grow into a professional executive. So at least that's what I told my um, nephew. Now, in terms of trends with hospitality, what I saw pre-COVID is you had a mix of corporate travel, you had transient travel and group travel. So hotels predominantly relied on this type of business. When COVID hit, obviously group travel and transient travel all came to a grinding halt. Corporate travel was very little, and in fact, when it was completely restricted, people relied on Zoom. People conducted themselves on Zoom, so that became the new normal for them. My uh, sort of outlook on this is that we adapted for the time and the circumstances that we were presented in 2020 and parts of 2021. After that, we as human beings need to get back to the way we did business, primarily because I think sometimes there's too many distractions at home. Sometimes you do need that separation from home and the office. Again, there's other schools of thought here. I'm simply presenting mine. And now what happened in after 2020 with the hospitality is that people thought, well, it's going to change forever. There's never going to be much travel, but we're social animals. And so what happened is after COVID, it was almost like revenge travel. All the occupancies shot up, and the vacancies in office buildings also shot up because people said, I can work from home, I don't have to go in. And employers acquiesced and agreed, okay, that's how we'll do business. We'll accept that. We today, as Avana, we have a combination of fully remote employees because we don't have a corporate location. But where we have a corporate location, we have employees come in, and that is a requirement. Now, are we flexible? Sure. If they have a baseball game to go to with their son, or if they've got to take their parents, aging parents, to medical appointments, absolutely. You've got to be very flexible. But these are things that I think all employers are going to adjust to. And I think the mix of travel between corporate, transient, and group is also going to change. I don't I don't see that complete equilibrium being reached anytime soon. I think it's going to take a little bit. Some markets have already got there, but other markets are taking a while, and therefore hospitality in these other markets that relied on what I call corporate travel are not there yet. The occupancy levels haven't got there. um, Airport travel near airport locations, near amusement parks, all that, that's doing just fine. Because, as I said, people are social animals. We love to travel. We want to be out. We want to experience things. So that's already occurring.
Yeah, I do see the recreation family, vacation travel Um, the I'm curious, do you see our uh, companies, are they focusing on deploying their people out in the field for, what used to be, whether it be client, uh, visits, or is it more to and fro corporate offices, or are they, um, are they bringing people in for like conventions, or are you seeing, has that, has there been like a change or even like a hybrid in that aspect?
I
Just,
think so. I mean, I don't know uh, enough to comment on how other Fortune 500 companies are addressing, what I call group training and group travel. I will say that we as a company do encourage travel. We like to go out and meet with clients. We do like to do, press the flesh, as it were. I mean, I was in New York yesterday. I could have taken that call on Zoom. It was with an institutional investor, but you know what? It was great to be in a conference room with him, and just to get to understand his background, just to be with him, that is irreplaceable. And to me, I think over the next year or 2 years, I think people will want to do more of that as we settle in. I do think hospitality in is for a little more challenges now with the new administration's uh, regulations that are being announced on tariffs, on immigration, on students. I mean, all of that has an impact on travel, specifically travel into the U.S. For leisure and hospitality predominantly. So I do think we're going to see that effect 6 months from now. We'll see how this all shakes out, but that is on my mind as of late.
yeah, no, I hear you. And it's interesting you were talking about just the option of taking that Zoom call or going and meeting in person. And there is a mentally, I know I go through it. It's like, oh, I could just do a Zoom kind of thing, but putting the little bit of extra effort
Yeah,
into the physical face to face, the benefits are tremendous. I mean,
yeah, yeah,
just from
absolutely.
there's like an energy, again, like you said, we're social people, and or just that need for that interaction. It's not, there's no other way to get it than to actually
Yeah,
be in front of somebody like that. But
yeah.
but I'm curious. Do you think that uh, do you find it to be situational, meaning like you have, even like what you were saying, you had the option, you could have done the Zoom. Uh, you think it's something that people will um, migrate more towards, or is it something that it will be like an option that they have, or do you have any sense for that, or is it just kind of more of
So
another tool in our tool belt kind of thing?
I I will give you an observation with my 15-year-old daughter. She's obviously raised in a generation where cell phones are just almost second nature, right? I feel that I hope society does revert back to physical meetings, shaking hands, breaking bread together, grabbing a quick lunch or coffee, because more and more, when you're so used to sending a text message or sending an email, we lose that sort of personal connection. So I think business is very personal, and I believe it will continue to be like that. And the best way to connect with someone is in their presence. Now, I'm sure there's a lot of companies out there that don't share my view because they're completely remote and they function just fine. I'm simply telling you, in the business I'm in, where I'm managing other people's money and I'm also lending, I need to be able to see the people because I need to make sure that they know that we're disciplined. We're going to be steadfast holding to their accounts, making sure that they're taken care of. And when we're meeting with borrowers, we want to make sure that there's certainty and reliability. When we say we're going to be able to close, they need to know that we are going to be at that table. So our business lends to this. There may be other businesses that work just fine remotely, but I believe society benefits a lot because we're so electronic already that it would be nice to be in person when we're conducting business because that matters.
Right. Well, I'm just kind of curious if there's I don't want to put a dollar amount to it, but it almost feels like there is some sort of a level of investment or a level
Mm,
of that, and I'm talking about dollar investment that equals the effort you'll put into to
correct.
making certain and to make sure you have the trust of the other party, whoever it is you're interacting with. If it's an Amazon shopping cart, and you're click click click. I mean, whatever. That's an easy enough thing. But if you're talking, investing, thousands or millions of dollars, um, take your time and make sure before you click the button. Uh,
Yeah.
yeah,
Yeah.
kind of thing. So that makes sense. So I'm curious with your involvement in the hospitality. Um, and we've talked about kind of the hybrid trends and how certain areas are benefiting more from this return. Um, are you when you speak and work with these hospitality businesses, is it a dollars are increasing? Is it a night spend? Because I'm curious also, and all this time the inflation has gone so
Yeah.
crazy. I'm having a hard time kind of resetting my own sense of value based on just what it was versus what it is. The numbers may be similar, but not necessarily the volume of in this case maybe nights uh, rented or whatever it is you're counting. There's kind of a just a reset based on the values in that. Are you seeing more of in these places where it's they've been more um, or they've received more of the back to regular travel? Is it a nights thing, or is it more of a dollars that their balance sheet's working better, or both?
Okay, so let me kind of sort of set a baseline here a little bit. So in the hospitality industry, there are three key metrics, right? It's called the occupancy rate, the average daily rate, and the RevPAR. The RevPAR is basically the multiplication of the occupancy rate with the average daily rate. And so just to kind of break that down, occupancy kind of tells you how many heads are in beds, right? Average daily rate tells you what is the charge, what are you charging, and that varies. If it's an immediate booking, obviously, now they've got algorithms that figure out what revenue that you're going to charge every week based on activities in the market, competition in the market, occupancy in the market, and so forth. And then RevPAR is basically the multiplication of those two. Now, it's important when you have inflationary costs going up, when you have perhaps the impact of tariffs, perhaps the impact of other things. If when cost drives up, hoteliers cannot immediately pass that cost on to consumers. It doesn't work that way. It takes a while, right? So yes, there is an impact, but the ones that can adjust are probably at the top tier, what I call, if you were considering, I don't want to say luxury, but upper tier brand, you could probably come down and accept a different type of customer because you've got that flex now, because obviously it costs more and you can't charge as much. But typically, I find the upper tiers do well because they have a specific type of customer that's less uh, worried about price. I mean, they're not that uh, sort of concerned. Now, the other segment that does well when we have these inflationary hikes is the bottom side, what I call budget hotels or extended stay, because they are the last place where you want to, where it is cheaper to stay and or stay for a longer period of time. So those do okay as well. So they're almost recession proof. I want to say almost, but they do well in recession. At least we found that out in our portfolio. The ones that struggle are in the middle. And it's those that I worry that when you have these kind of shocks, immediately, they're being hit by all sorts of things. Uh, Labor costs could go up. Uh, Rates are up. So if they have a variable rate loan, they're paying more on their mortgage. And if price has gone up, in terms of resources that they need for their hotel, then the tariffs are going to hurt them. So those are the concerns I currently. We're obviously watching our portfolio, but those are the concerns I have right now. Long-term outlook, I think the hospitality industry is going to do well. And primarily because as much as everything is moving digitally, I still think that the one thing we're born with is wanting to be in the company of others. And as long as that exists, I think the hotels will do well. Now, what people are being very specific about is the type of experience. You may want to experience something that's quiet, modern, perhaps. Someone may want to just go no frills and have like a business traveler who want to come in, and so they'll gravitate to that type of brand. So these hotel brands are now becoming very specific on the type of experiences because they've really segmented their customer very quick, to almost to a science. I mean, they've got down to what type of customer will go to what type of brand and in what type of segment. So it's really becoming very, very what do you call it? Micro targeting of the type of customer you want.
Yeah, the data scientists have figured it all out. I mean, they've got it all the segments, and I mean, it's scary how specific you can get, and make your algorithm, whatever industry you're into, to reflect more of the client or the opportunities that you can do well and do better with. But it is interesting how you mentioned, how the upper end has kind of the upper hand in this, and that they've got the clients that are less price sensitive, and then
Yeah,
also they have the margin to back off the
correct,
price if need be, kind of thing. Whereas if a bottom or middle, the middle kind of is more the squeeze point there. So
correct,
yeah,
correct.
interesting.
Yeah.
Um, and with the hospitality, do you get into, or is restaurants, is that any kind of a segment that you deal with, or is this is specifically
We
the lodging?
Ye- That's a great question, Darren. Hospitality is quite broad. We've stuck close to hotels and specifically branded hotels. We've done a few bed and breakfast. We largely stay away from restaurants because we don't really understand them. I mean, when I say
Right.
we really don't understand the economics of how to do that, and let's say we had to take one over, it would be so unique, so difficult that it's not an asset class that I feel comfortable sitting across my investor and saying, that's something we would be able to take over and liquidate and return your money back on. So, no, we stay away from restaurants. But I will say that we have looked at franchising, right? We did look at that previously, franchise restaurants. But again, it's such a unique skill set because it's a hard business. It really is, and you have to have a certain mindset on how you put people on each of these tables, how you revolve those tables. It's not something that we wanted to develop an operational expertise in, so we stuck to the hospitality and construction segment.
Got it. As far as Ivana, can you tell a little bit about what level of investment that you guys work with as far as an investor, or do you have, I mean, do you have a fund? Do you
Yeah,
do individual assets? How do you go about raising capital?
Darren, there are a couple ways that we can do this. So we do have a fund. And the fund definition has accredited investors in America. Now, the new regulations allow accredited investors that start with $200,000 as an investment, do not have to answer a lot of the verification questions to confirm or verify that they're accredited, right? So there is that. We've got that ability. We have a platform called Equal Seat that allows people to come in, sign up, and deposit $200,000. Anything less than that, they have to go through and verify that they are accredited by submitting personal financial statements, tax returns, all sorts of things that are verified by a third party. There's the other segment, other structure that we have, what's called a segregated managed account, which is for large institutions. Just take an example. We have a pension fund that gives us 50 million. They are under an SMA, so they have a mandate and a box that we maintain for them, which means we will only originate and put in that portfolio transactions that meet that box. Now, they may say, look, we're interested, but we don't want to invest in, I'm making this up, so this is just an example. We don't want to invest in Florida. And okay, so so that means we have to make sure all the transactions that we bring in that box don't are not in Florida. So that's another way. So the first way is the fund, the second way is an SMA, and the third way is that they can do co-invest or co-lend directly. So when we're making a loan to, let's say, Mr. John Smith in New York, then as Avana would be a lender, but with Avana, we would set up an SPV, and the person, typically a large ultra high net worth individual or an institution, will co-lend with us. So we'll be directly lending, and our mortgage will be recorded with the two parties on that mortgage. So those are the three ways that we currently raise capital and onboard investors.
Got it. And then as far as your borrowers, you mentioned more of the name brands. Can you describe a range
Sure.
of uh,
So our borrowers are
clients? Yeah.
typically multi-unit operators. They have one or two hotels, typically a Marriott, Hilton, all the franchisors, Choice, IHG, Wyndham, and so they're they're typically looking for a deal size anywhere from 10 to 25 million. Um, we could go higher, but we're not doing that anymore. We're staying under 20-25 million. And part of this is because our institutional mandate that we want to have a good diversification of loans in that initial first mandate that we've got from one of our partners.
When you're underwriting for that, is the when you value a hotel, how much of that is asset underwriting as opposed to operation underwriting?
So it's a combination of both, but we're typically only going to look at the cash flow. I mean, you do look at asset underwriting, as you just said, because you then ask yourself, what would it cost to build a similar asset in that market today? So that's sort of almost a data point to check, but you're really looking at the property's ability to generate cash flow and what that translates to in terms of a value. Because in the CR commercial real estate space, as I'm sure you know this already, that we rely on cap rates. And the cap rates obviously are different based on the type of market, type of brand, and that determines the value. So what we do today, obviously we have MAI approved appraisers that go out there and give us a report. We'll also look at third-party market data like CoStar to see what's going on in that market. But then we have a system internally where we'll do an entire appraisal review. So we won't just take someone's word for it, because at the end of the day, you have to remember we're paying an appraiser to give us a value. So let's just say that there is a certain amount of baked in bias right there. So we go in and we'll go ahead and tear that appraisal apart to make sure that A, they use the right comps. Is a cap rate that they've used something we agree with? All of that we'll do. And if we disagree, what we'll do is we'll just write down the value and right size the loan accordingly. Because at the end of the day, it's just a data point of checking for us. But we do it on every single transaction.
Got it. So as far as cap rate range, what kind of a range of cap rates do you find in the hotels?
Ah, gosh, they've gone up, Darren. They've really gone up. Anywhere from 8 to 10 or 8 to 12 now. But yeah, they've really gone up. Um, Not seeing much lower than that.
Well, and it's funny because historically, I've been investing myself in real estate for close to 30 years. And I remember reading books a long time ago, and there was like almost a rule that a cap rate was always like 7 or 8%, and it was more historically based on the cost of capital. Now, this was talking about long-term rentals as opposed to, um, you know, a hospitality. But what's interesting is just the cost of capital, how that really, it's
Yeah,
more of a mirror of that,
correct.
and the spread there. So it is kind of a reset
Yeah,
thing. But like you said, it's come up, and my sense is that if people get comfortable working in this new reset, things work. It's the when you go from a set point to a new set point, that transition where everybody's like, oh my God, oh my God, oh my God,
yeah.
and
You're absolutely correct because borrowers had to reset their expectations, right, Darren? There was a time when they thought 5 or 6% was normal, right? And then they had to reset their expectation to saying, oh, 9 or 10 is normal now, or 11. And what's made it harder is for good borrowers, we see so much that we have to cull through so much to qualify them because the rates are higher. And as the rates moved up from, let's say, 5, 6% to 11, 12, businesses didn't grow dramatically. Businesses didn't multiply 50%, right? And the
yeah,
cash flows didn't multiply. The EBITDA didn't multiply 50%. So what happens is for those reasons, we're actually culling through a lot more transactions to just make them qualify because you have to stress test every transaction coming in. Because we'll stress test each transaction by saying if it's 10%, then we are going to stress test at 12%. So we add 200 basis points to the to stress test, or we will also drop their net operating income by 10% just to see if they'll qualify, right? So now
yeah,
when you're doing that and the baseline has moved up from 6 to 10,
yeah. It's
it's
pretty tough to
harder.
qualify.
Yeah, it's harder. It's just
Yeah,
harder.
yeah,
So in fact, I tell my investors now that, hey, if you see a recessionary cycle coming, and perhaps we may get there, I tell them that's the best time to invest. We made our best loans in the worst of times, 2008, 2020. I mean, honestly, we made our best loans to borrowers during those times.
yeah. No, it is true, and it's that being set and the ability to recognize the opportunity as opposed to be caught up in the panic or the
Correct.
just the fear and the doubt. And it takes preparation and discipline and all of those things. But yeah, it's I have come to recognize and appreciate that as much as the consumer and myself included likes a steady as she goes kind of a rate because I can prepare for that or I can anticipate what it's going to be. The opportunity is in the highs and the lows, the dips and
Correct.
the falls.
Right.
And understanding that it doesn't mean that it's comfortable going through that, but
Mm-mm.
to recognize that that is, to be ready for those opportunities is where
Correct.
you're going to make your money. So,
Correct. So I follow Howard Marks. Oak Tree Capital is a partner of ours, and I follow his memos. And one of the things he writes very well about is knowing and not panicking during these highs and lows, and just understanding that they present a different set of opportunities and the fact that we've been here before. It's nothing new. It's just presenting itself in a different way.
right. And I think the other thing with that is whatever broke it last time is not going to be the thing that breaks it this time. Or,
Yeah,
it's
yeah,
just but being ready. But
Yeah.
anyway, hey, Sundip, if we could, I'd like to shift gears here for a second.
Okay.
By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the Fed, the back to work trends, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer.
Yeah.
And so if you're willing, I'd like to ask you, Sundip Patel, what is the biggest risk?
That's a great question, Darren, by the way. So the biggest risk that I foresee and in our business is the underestimating of the impact of AI and to our business and everything we do, from assessing risk, evaluating risk, to funding that risk, the entire process. So we as a company have taken some bold steps to get ahead, to understand how we can apply AI and what it will mean. As you remember, when we started the conversation, my mission was to create jobs and maintain jobs. I live with that fear today because you're asking me what's the biggest risk. This is the risk that keeps me awake in the middle of the night, when I think that I'm underestimating the true impact of AI that's coming really fast upon us, and the sweeping impact it will have across all businesses, not just mine, but even others. And right now, I'm focused on making sure mine and my employees are upskilled and ready and changing fast, so we can do more with less, but at least be ahead.
Those are some true words. The AI and its impact I I'm still kind of I marvel at it, and I also get kind of annoyed, but I recognize it's going to change everything.
Yeah,
And so uh, buckle up, I guess.
yeah.
Hey, Sundip, where can the listeners go if they'd like to learn more or connect with you?
So I'm on LinkedIn. I have a good accounting marketing team that really helps me with that. But LinkedIn is the best way. And I would love to talk and connect with any commercial real estate professionals or anyone that's interested in the topics we've talked about today.
Awesome. Well, Sundip Patel, I cannot say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again.
Darren, thank you so much. I really appreciate your time. Take
All
care,
right.
buddy. All right,
All
man.
right. Hey, for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.